This is Richard Rahn, reporting from my beautiful Miami, Florida. As you've probably noticed, the world has gone a bit berserk over this past year with the pandemic. Unfortunately, a lot of basic economic lessons, which have been known for the last 200 years, have been forgotten over this past year. Namely, government spending. We used to understand there was a limit to how much governments could spend before they would do a lot of economic damage. We've come into a world where governments think they can spend unlimited amounts of money without undue consequences. And so the question here is really, what is money? How much money can governments spend? In the past, there was often a lot of basic discipline because people thought government spending in sort of terms of their own spending. And they knew if they spent too much money, that they'd eventually have to pay it back. And if they spent too much, they wouldn't be able to pay it back, and there would be dire consequences of all of this. We've had this sort of rise in what they call new monetary theory, which is, I think, going to end up in disaster. But we've had huge increases in the money supply in the US, Europe, most other places around the world because, again, of the pandemic. Governments, as I pointed out in earlier videos, have greatly expanded their spending, but they haven't taxed to cover this yet. They talk about future taxes. So all this has been borrowed money. And it's interesting how governments borrow, because nowadays it is pretty much printing money. And those of you who've had courses in economics, you probably learned if the government just goes out there and prints money, eventually this is going to lead to inflation, and there's going to be dire consequences. There's countries like Zimbabwe and Argentina and others who've just printed money. But now we have the US and Europe and Japan and other places doing this exact thing. They do it in a different wrinkle. Typically what happens now is that the finance ministries, the treasury departments of countries issue new debt, and they auction off the debt, and big banks, big financial institutions come in and they bid on these, in the US we call them treasury bills, or various types of government paper. Then these banks turn around and sell them to the central banks. And the US Federal Reserve or the European Central Bank have been buying these government securities from the banks rather than the central bank buying it directly from the government. They have this indirect, and the banks are willing to bid very low amounts of money on these government securities because they know they can turn right around and sell them at a bit of a profit to the central banks at really no cost. The central banks then have all this government paper, and they know if they just went out there and told the commercial banks who have gotten all this new money that they could go out there and lend and spend it all, that would immediately lead to inflation. So what they do, it's a sleight of hand. They tell the commercial banks, well, you need to increase your reserves, but we'll pay you on these increased reserves. So this money gets bottled up in the central banks, and the central bank's balance sheets greatly improve, but at the same time, they're not really lending a whole lot of money to the private sector. Now with the, hopefully, end of the pandemic, the governments want the private sector to expand, go out there and hire people, borrow more money. So what they're doing is reducing or eliminating the interest rates on reserves, basically eliminating the reserve requirements. And the idea is that the private sector will take all this new money and then spread it around the economy. The problem is this will likely lead to inflation at some point, or much higher rates of inflation. we're already seeing some of this with a rise in commodity inflation, oil prices, and so forth. The central banks at this point believe they can still control it. The jury is out whether or not they will be able to. But the problem is, if they can control it, and interest rates and inflation, when I say inflation particularly, start to rise at a very rapid point, like it did in the 1970s, and you have inflation rates, even in a developed country like the US, 14, 15% or higher, there's no way in financing all the debt that is now out there, because the debts for many of the countries are now more than 100% of GDP, which is a very different circumstance than governments faced 40 years ago. At this point, the central banks have fewer tools to try to contain inflation. And this could be really a disaster where things get totally out of hand, and it'll make the 1970s look like a picnic compared to what could happen. Well, people, of course, see this coming along. So what you've had is the rise in private currencies, and particularly Bitcoin is the biggest example. People are going out there and buying Bitcoin, and the price keeps getting bid up. Bitcoin, there's nothing behind it. It's not like the old gold standard where there was something real behind it. And there's all these other cryptocurrencies. There's also a number of basically digital currencies that do have backing behind them. Some are experimenting with gold and silver. Others of us are experimenting with base metals like aluminum and copper and so forth. It's going to be interesting to see how all this turns out in the end. But it's probably useful to have a little bit of monetary history to think about how we got to this standpoint. Traditionally, governments produce coins, gold and silver coins. And it goes back to the Greeks and Romans. The Romans started to cheat in the later days of the Roman Empire by making the coins a bit smaller or shaving them. And that's why you tend to have ripples in the edges of coins to keep people from shaving the precious metals and coins. In places like England, the city-states in the Netherlands, and the Italian city-states, you had a lot of private issuers of coins, of gold and silver coins. And you have, the gold merchants, these merchants, they noticed that a lot of their customers preferred to leave the gold and silver with the gold merchant because the goldsmith, it was commonly known, because people didn't have safe deposits or vaults in their homes. The homes tend to be insecure, and so you have the gold dealers, goldsmiths, who would offer to actually hold on to customers' gold, and they'd get a paper certificate saying how much was gold they had back at the goldsmith. This is actually how a lot of commercial banks initially evolved. So the goldsmith would notice that not everybody would come and ask for the gold at the same time. So the goldsmiths would lend out the gold, but often they lent out more gold than they actually had on the basis that not everybody's going to come asking for it at the same time. And that's how reserve banking essentially evolved. So we had after really the fall of the Roman Empire, during the Middle Ages, the rise of these private banks in Europe, England again, Netherlands, Italy particularly. And then the world moved more steadily towards a gold standard. And really the English led the way, and starting in the 1820s, they pretty much moved to a total gold standard. The Bank of England was a private bank. It wasn't a government bank until really this past century. And the Bank of England was sort of the benchmark of where this was established. of how much gold it would be for a British pound or how much silver. And when the world sort of adopted the gold standard, again led by the British, but then the French and the Germans and the Japanese and the Americans and all the major economies went on the gold standard. So by the late 1800s, virtually the whole world was on the gold standard. When the world was on the gold standard, there wasn't any difference between exchange rates between countries. Everybody had the same money essentially, and so the risk of holding a foreign currency was not a major risk. And the gold standard actually worked quite well. There was problems with it. It's a little bit deflationary, but for the most part, it worked far better than other monetary standards that had happened. At the beginning of the First World War, governments needed to borrow a lot of money to pay for the munitions for the war effort. And they didn't have enough gold to do this. So a lot of them went off the gold standard and just started issuing government paper, which was not fully backed by gold. And then after World War I, most of the countries tried to go back on the gold standard, but at a higher rate, I mean more gold per unit of paper, meaning the government paper was worth less than they had before World War I. And these partial gold standards staggered along during the 20s, the 30s, the Great Depression, and we don't have time today to go into all the details. But by 1972, the U.S. was the last remainder on the gold standard where it recognized the ability of foreign countries to come in and get gold in exchange for U.S. dollars. And they started to have a big run on the U.S. dollar, and particularly the French were coming in and demanding gold for their U.S. dollars. And so the U.S. stopped making this exchange, and the world went off the gold standard when the U.S. did in 1972. After that, paper money reigned supreme. And as long as governments limited the issuance of paper money, things worked reasonably well. But governments didn't limit the issue. We had the great inflations in the 1970s, and which was curtailed in the 1980s. But now we're back at a time again where governments are issuing huge quantities of money, and they have no good way to contain this. And many of us are quite concerned about where this is leading, because the way out is not obvious, but increasingly people will probably find private substitutes for government monies. And so I look at this next few years as a period of very high risk, and people need to think about alternative investments, because government currencies will not be a store of value as they have been over the last 20 years. Governments during the pandemic understandably want to increase spending to make up for the loss of income that their citizens and businesses had as the world economy was shut down. Now that's a nice goal, but the problem is just providing people money without having the offsetting increase in goods and services will eventually lead to very uncomfortable or worse circumstances. Years ago, a number of us had looked at what was the optimum size of government spending. In the 1980s, I was chief economist of the U.S. Chamber of Commerce, and we established a project there to try to determine how big governments ought to be to maximize economic growth and the general welfare. And at that point, the data wasn't very good. We didn't have enough countries where spending had gone up and down. But our preliminary indications were that government spending more than about a quarter of national income was probably counterproductive. In the years since, there's been many studies done by many academics and think tanks and so forth. which basically reaffirmed many of our early conclusions. It is clear that government spending above a third of GDP definitely slows economic growth. Government spending of less than 12% of GDP is usually too small to provide the necessary criminal justice system and the courts and basic infrastructure and health programs that are needed, as well as education. Most governments spend above the optimum. And let's say the optimum is ideally 25% or a little bit less. But once you get above 30%, economic growth slows, job creation slows, and the general welfare declines. At some point, getting up around 50% of GDP, depending on the nature of the country, economic growth can grind to a halt. Small homogeneous countries like Finland can spend higher amounts of money as a percentage of GDP than larger heterogeneous countries such as the United States. Government spending comes down to several different types, and how the government spends the money is extremely important for the growth in the basic welfare. Government spending, first of all, for defense. All governments have as a primary responsibility to defend their populations. Defense spending is sort of like an insurance policy. It's necessary, but it's not directly productive. And so you've got to spend enough to dissuade enemies from attacking you, but not so much that you drain unnecessarily from your economy. The biggest single area of government spending is transfer payments. And those are things like unemployment insurance, the various types of Social Security, welfare, and all of that. Transfer payments are often given on the basis that the people do no productive work in order to receive the transfer. As a result, transfer payments tend to be a net negative to the economy because the government is spending money but getting nothing in return, in fact, often explicitly not requiring or allowing anything in return. So as governments get bigger and more developed, they tend to do more in the way of transfer payments. Again, there's retirement programs, various types of social welfare programs, many of the medical programs, and so forth. Then there's also government spending on infrastructure. And most people think, well, this is a good idea. Infrastructure spending can be very beneficial for the economy if it is well done. In the United States, one of our very successful infrastructure programs was building what we call our interstate highway system. That system was built at reasonable cost, but it greatly reduced transportation costs among the states, enabled people to get around faster and cheaper, and particularly the trucks and the goods and so forth. Great benefit. Governments can build things like dams, and if a dam is well thought out and a project well managed, it can have enormous savings in terms of flood control, irrigation, power generation, and so forth. Unfortunately, in a lot of places in the world, dams are built and they run excessive cost, or they're not well engineered. I remember there was a case years ago, there's some dams in Texas and some Texas rivers where the dam builders had not sufficiently calculated the amount of buildup of silt and things behind the dams, and all too soon they silted up to the top, destroying much of the value of the dam. But those are more unusual. Then we have, of course, government spending on just basic goods and services like any business would spend. And this gets down to the efficiency of the people within government, making sure the procedures are non-corrupt. So the basic bottom line is government spending can either be a benefit to the economy or a big negative. As governments get bigger, and as a share of the economy, they tend to do again more in transfer payments, which are always a negative, and they're necessary. I mean, we want people to have, we don't want people starving in the streets, and provide the basic things we need for civil society. What we've had with the pandemic is a huge increase in government spending. In the United States, for instance, it's been up about a quarter. This is true with many other countries around the world. And so temporarily, you can endure this without too much in the way of negative side effects. But the indications are that many governments, and again including the United States, are going to keep government spending at a much higher level than it was before the pandemic. And already we are beyond the optimal levels of government spending. And this is something that people really need to be concerned about, of bringing that spending levels down to where it is not a drag on future economic growth and employment. Along with that, people say, well, we've got to pay for the spending through increasing taxes. And as fairly well known, tax rates, the higher the tax rate, the slower the rate of economic growth. High tax rates tend to bring in no additional revenue. There was a famous U.S. economist named Arthur Laffer and his so-called Laffer curve that looked at the optimum level of income taxation. And he found as tax rates got beyond a certain point, and again, we're talking about 25% or so, depending on income levels, that that people tended to work less, they saved less, and the economy slowed. There are a lot of proposals now to tax the rich. The problem with those ideas is the rich have the ability to move both their physical bodies to low tax jurisdictions, and particularly move their businesses and capital. And in the United States, we've got a big flood of people, of rich people out of high tax states like New York and New Jersey and California, moving to lower tax states like Texas and Florida. That same thing happens internationally, of course. And countries that try to overtax their people, they find the people leave. The Scandinavians found this out 30 years ago. They had very high tax rates, and a number of their most wealthy, highest income earners packed up and left. And after that, the Swedes and others reduced their tax rates to levels that people would accept and would stay at home. Tax rates on companies are the same thing. Companies are very mobile, where they put their corporate headquarters, where they build their factories, and so forth. Ireland had a very favorable tax rate, low rates of taxation, and it grew very, very rapidly. And many U.S. companies had moved to Ireland. So the U.S. reduced its corporate tax rates, and a lot of these companies came back to the U.S. 30 years ago, during the economic transition in Eastern Europe, some countries like Bulgaria became very rational, and they reduced their tax rates so that they had a personal and corporate tax rate of no more than 10%. The result was that tax revenues actually increased because people found it easier to pay the tax than pay the bribe for not paying a tax. At 10%, they could be totally law-abiding, and the government got considerable revenue off this. Russia did the same thing. They reduced their tax rate from over 30% to a 13% flat tax. And we've seen these flat taxes have tended to work very well in places that have tried, that revenues actually increase, and it doesn't discourage work, saving, and investment if the rates are kept low. Same thing is true of things like tariffs. There's a lot of discussion now about increasing tariffs, often punitive tariffs for political reasons, like on the Chinese. But the tariffs, the debate over what is the optimum tariff in terms of maximizing revenue to the government goes back several hundred years. Many years ago, I found some letters between the great French economist J.B. Say and Thomas Jefferson, who was our third president, but also a very smart man. And they had a discussion about what the optimum tariff level was between the U.S. and France, because they wanted a tariff high enough to bring in revenue, but not so high as to encourage more smuggling or just no economic activity. And it was interesting seeing this exchange of letters, because both of them were very aware of the sensitivity to tariff rates and whether or not the activity would move into black markets, smuggling and so forth, or just stop altogether. And that was one of the great debates at the time of the American Revolution, with the tea tax imposed by the British. So again, the key thing to remember is, despite the pandemic and the big growth in government, we have to make sure that is temporary, both in spending and particularly not make the mistake of trying to increase tax rates, which are in most places already higher than the revenue and welfare maximizing rates. We need to bring governments back down for the long run health and employment. If we don't do that, we're going to have economic stagnation, and that can be, of course, throughout the world.